U.S. President Donald Trump, he made a comment the other day about U.S. banks being blocked from doing business in Canada as he was going on one of his rants. Here's what he said.
We're not treated well by Canada, and we have to be treated well. Banks are not, as an example, allowed. Did you know that banks, American banks, are not allowed to do business in Canada? Can you believe that?
Well, as it turns out, of course, that isn't exactly true, but he did touch on a bigger issue, which is how tough is it for foreign banks to actually compete in Canada? Is our banking system too closed off and could things actually change? I want to break that down in this video today. Now, in Canada, of course, there are 6 big banks that pretty much run the show. You've got RBC, Toronto Dominion Bank, BMO, CIBC, Scotiabank, and National Bank. And these 6 banks control over 90% of the market. So it makes it very, very difficult for any, competition to sort of seriously make a move here. And especially when it comes to foreign ones to sort of get in on the game here. If you want to start a bank in Canada, you're looking at a process that takes 3 to 5 years at a minimum, with a lot of regulatory hoops that you have to jump through. Now, foreign banks can operate in Canada, but most of them don't bother even trying to break, especially into the consumer banking segment. And as for President Trump's assertions, right now there are actually 16 U.S. banks that do business here in Canada. They control around $113 billion in assets, but that's mostly in the commercial banking and on the wealth management side of things. Now, on the other hand, Canadian banks, they've had much more success expanding into the U.S. The banking industry there is much bigger, it's much more fragmented, and generally it's just easier to get started there. RBC, TD, BMO, in particular, they've all have pretty strong business assets south of the border. So the question, I guess, is why is it so hard to compete here in Canada? There are a few reasons I'll highlight here of why foreign banks and even Canadian startups struggle to get a foothold. First off, there are very, very strict regulations here. The government wants to keep the banking system stable, so they have very tough rules for new banks. You have to prove financial strength. That kind of makes sense. You have to have a detailed exit plan in case things go wrong, and there are a ton of compliance requirements that you have to go through. Another reason, market control. These big 6 banks, they've been around forever. They've built very, very deep relationships with customers, and that dominance is pretty hard to shake. Customer loyalty, sort of piggybacking off that, even though a lot of Canadians claim to hate their banks, reality is they don't really switch very often. So even when foreign banks have tried to attract customers, they ended up leaving the market just because they couldn't gain enough traction. Now, ownership limits is another issue here. No single investor can own more than 10% of a Canadian bank. And that means that foreign takeovers of major banks here in Canada are basically off the table right from the get-go. There are exceptions that the Minister of Finance can make, but it would be extremely rare and certainly doesn't really come into play with what we're talking about here. So a fair question this might lead you to, is this a problem? Or is this just smart regulation on the part of Canada? Well, it depends on who you ask. When you talk with supporters of the current system, they'll argue that Canada's strict banking rules have kept the system stable. It's prevented crisis. And we think back to the one that hit the U.S. back in 2008 and then again in 2023. The big thinking here kind of is, if it ain't broke, why bother fixing it? Now, critics of this policy will say that it limits consumer choice. It stifles innovation. They're saying that more competition could mean better services, lower fees, and more digital banking options in the industry or in the era that we live in now. Now, even Canada's banking regulator, so this is OSFI, this is the Office of the Superintendent of Financial Institutions, they've admitted that the country's conservative approach might be holding back innovation, especially when it comes to this digital finance space. So a reasonable question would be, how will this change, or could it even in fact change? And in theory, the answer to that question is yes. The government has in fact looked at ways that it can boost competition before, but to this point, nothing major has happened. We're seeing an era now, though, where we're getting a lot of international pressure, especially from the U.S. as it's ramping up here. And it could push Canada to sort of rethink the way things are done here. We have seen other countries. We think of the UK. They're debating whether to loosen banking regulations, encourage competition and innovation. And if Canada does move in that direction, we could see more banks entering the market. We could see increased competition. And then, of course, potentially lower fees and better services. There is, however, of course, always that flip side And if we relax regulations too much, that could bring some instability to the system. And that's something that Canada's regulators, of course, are going to be very aware of. So should Canada make it easier for foreign banks to compete, or is the current system working just fine? Now, what do you think? Let me know in the comments below. Now, on the topic of banking, and especially in light of this sort of the light shining now on the US-Canada debate, news was out this morning that TD Bank is selling its entire stake in Charles Schwab. The ticket there is $14 billion, and it's exiting its 10% ownership. Now this comes as CEO Raymond Chun. He is restructuring the bank's finances, and this comes on the heels of the U.S. regulatory penalties that they've been slapped with recently. He says, as part of our strategic review, we have been evaluating capital allocation and have made the decision to exit our Schwab investment. In large part as well, this sale is driven by TD's guilty plea in October. They pled guilty to conspiracy to commit money laundering in the States. That resulted in a $434 billion asset cap on its U.S. retail business. Now, previously, the bank sold 40.5 million Schwab shares in August, and that was to help cover some of the related fines. Now, Chun has indicated that everything is on the table, including the potential sale of mortgage and auto loan portfolios in the U.S. To help stabilize the bank's finances. In this case, TD plans to use the $8 billion from the sale to buy back $100 million of its own shares, about 5.7% of its total outstanding shares right now. And it also intends to reinvest in its businesses to drive performance and accelerate organic growth. Now, Chun says here, in just under 5 years, this investment has generated a very strong return, and we believe this is the right time to reallocate the capital. So this sale will go through, but TD has mentioned that it will be maintaining its deposit agreement with Schwab, and that will allow it to manage cash and still continue to collect fees on deposits. Now, word from the analyst community this morning generally came out positive, with most seeing this move as financially wise, but they do know that TD is giving up a highly profitable investment. Now, retirement planning in Canada can feel pretty overwhelming at times, but the good news is you don't have to figure it out alone. And that's why I'm teaming up with Adam Bourne. Now, he's well known to a lot of Canadians for his expert advice that he gives on Parallel Wealth. That's one of Canada's top retirement-focused YouTube channels. And together, Adam and I will be launching a brand new monthly episode on my Beavis Wealth podcast. Each month, what we're going to do is we're going to answer your questions about retirement. Those questions will be taken straight from my YouTube videos, and we'll add additional commentary as well. Now, episode 1 of my new retirement series is live now. If you haven't watched it, you can go check it out. I will put a link in the description here. If you have any questions that come out of that, drop them in the comments. We might answer your questions here in the next podcast episode. So watch episode 1 now, send in your questions, and follow us on the Beavis Wealth podcast. I want to shift now over to unemployment. And we have fresh job reports out from both Canada and the US. And we are seeing signs of resilience here, even though the markets are generally expecting that things might be slowing down. So let's break down those numbers and see what is going on. First off, here in Canada, a big surprise. In January, unemployment dropped to 6.6%, and that came better than forecasts, which were predicting a rise to 6.8%, and that is now the lowest in 3 months. And it is a sign that the Canadian labor market might be a little more resilient than a lot of us have been expecting. Some of the key numbers, the unemployment rate came in at 6.6%. That's down from 6.7% in December. Number of unemployed individuals, well, that's little changed at 1.49 million. As far as jobs added, there was a massive 76,000, and that comes in far above the expectations, which were 25,000. And total employment now sits at 21 million. So these numbers are a pretty big deal, considering the Bank of Canada has been warning about the labor market softening. The numbers also do suggest that the job market is holding up better than expected. Now, in the U.S., we did see a small but pretty solid improvement. In January, the U.S. unemployment rate dipped to 4.0%. That's down 0.1 percentage points from December. That's now the lowest level since May, just below expectations of 4.1%. Some of the key numbers here: unemployed individuals down 37,000, now at 6.85 million. Employment, that was up by 2.2 million, reaching 164 million. The labor force participation rate, 62.6%. That's a small increase. And the employment rate, that came in at 60.1%. So again, that's modest, but a steady sign that the labor market does remain pretty strong. So when I look at what this means, well, here in Canada, this strong report, it does maybe ease some of the concerns about the economic slowdown that we've been hearing so much about. always a flip side. If this labor market does stay strong or gets too strong, then the Bank of Canada, of course, may have to hold off on rate cuts for longer than expected. When we look into the U.S., this new report, it could reinforce some confidence that the labor market there still does remain stable. Potentially, it could influence the Federal Reserve as they deliberate on the next interest rate decision. As of today, the FedWatch tool says that there's a 91.5% chance of no change when the Fed makes its next decision in March. Now, I don't think that this drop in unemployment is going to change the Fed's outlook dramatically, but it does show that continued resilience. The biggest picture here, both economies are showing these stronger than expected job numbers. And so I question, is that a trend or is this just a temporary boost that we're seeing now? Leave your comment below. That is all for this episode. As always, I'll say thank you for watching the video. We'll see you again soon.